Hello everyone. So today we are going to discuss about budgeting and we are discussing today cash budget. So as we know guys, in the last class we have discussed about how to prepare the operational budget. In operational budget we discussed how to prepare a sales budget, then how to prepare production budget, then under production budget how to prepare direct material budget, direct labor budget, manufacturing overhead budget. We also discussed about ending finished goods inventory budget. We also discussed about cost of goods sold budget. Then we discussed about non-manufacturing budget. Then we prepared pro forma income statement. For today class, our topic is financial budget. So under financial budget, guys, first of all, we have here capital budget. Okay. So under capital budget, actually, we will decide how much money we need to spend to buy non-current asset. Okay. So actually, capital budgeting, we are not going to prepare here. Capital budgeting, you will study in CMA part 2. Okay. Once capital budget is decided, let's assume it is decided that you will spend $100,000 to buy non-current assets. So then which budget is prepared? Then cash budget is prepared. So in cash budget, guys, we have to actually write how much. Obviously, in cash budget, you will write overall two things. You will write about inflows of the cash, which is also called cash receipts. We will also write about the cash outflows, which is also called cash disbursement. Because capital budget will affect this budget, okay? Because the money which you will spend to buy non-current assets, we need a cash. So that will be considered as a outflow. Understood? So this is what we are going to discuss. Once cash budget will be ready, so then we can prepare pro forma balance sheet and pro forma statement of cash flows. Please remember, these two things are not required to prepare in your exam. Okay. So here we go. So our topic for day is cash budget. So this is what we are going to discuss now. So here we go. So first of all, we have a definition of cash budget. So what is cash budget? A cash budget is an estimation of cash flows. Okay, here you will estimate the cash flows. Cash flows mean to say cash inflows and cash outflows. Okay, so we will estimate, we will predict for the future. Okay, for a specific period of time, because mostly cash budget we can prepare up to 1 year or less. Maybe you can prepare even for 2 months, 3 months, or one quarter, or for 2 quarters. So in cash budget, as I told you, what you will write, you will write projected cash receipts, which are called inflow, and projected cash payments, which are called disbursement, right? So why we are preparing this cash budget? Actually, the reason is, so the cash budget is always provide us the comprehensive pictures of sources of cash, like from where we are receiving the cash and the uses of cash. Sources means say from where you will get it, like it's simply inflows, and uses means say where you will spend, simply it means outflows. Okay, so for planning purpose we need the reason. Sometimes some companies they might have a huge quantity or huge amount of other non-current asset, but if they will have a temporary shortage of cash, so temporary shortage of cash can be driven into bankruptcy. Like maybe for example, you have machinery plant with you, but you don't have a cash to pay salaries, you don't have a cash to serve your creditors, like you are not able to pay interest, or you are not able to repay the principal amount. Obviously it will be an alarming situation for the business, so you might be on the default risk. Understood, guys? I hope so it is clear. Now guys, here we go. First I'm going to explain like what items they might include in receipts. Receipts mean to say in inflows, and which items might be the part of payments. Payments mean to say outflows. So here we have just few examples. I'm going to discuss, and then I'll explain how the question will be tested in essay style question and how the question will be tested in MCQs from this topic. This topic is important because you may face 2 to 3 MCQs in your MCQ section. So cash receipts are collection, which is also called inflows. It might include the cash sales. Obviously, when you sell the goods on cash basis, so obviously customer is paying you on the spot. So that is also cash receipt or inflow. So then cash collection from the customer. What it means, sometimes we sell the goods on credit, right? Maybe today we are selling goods on credit. Maybe customer will pay us after 20 days or 30 days. So that cash collection from the customer is also your inflow. Then we have a dividend on investment in stocks of other company. So this is also your inflow. For example, as a company, if you have a surplus cash flows, so you may invest in the stocks of other company, right? So if you will invest, obviously other companies, they may pay you some amount of dividend as a return. So that amount of dividend which you are receiving on your investment in stock of other companies, so that is going to be your cash collection or cash receipts. Sometimes you have an interest received on investment in the bonds of other company. So sometimes, guys, obviously you may invest in the bonds, you may buy the bonds of other company. Obviously other companies, they may pay you interest, so that interest is also receipt for you because it is interest received. Then you might have an interest received on loan to others. Just think from the bank point of view. If you are a bank, obviously you are lending money to other companies. So other companies, so they are paying you interest on that. So interest received on loan to other, it is also your cash receipts. Then you have a cash received through the loan from bank, etc. Here you can put yourself in a situation. Let's assume you are a company. You are going to borrow a money from a bank, right? So at the time when you are borrowing money, it is an inflow for you because you are taking loan. So you are receiving cash. So this could be your cash receipts. Then you have a issuance of own stock. Now again, assume if you are a company and you are going to issue your stocks, your shares to the public. Obviously, once the public will invest in your shares, so you are going to get the money. So this is going to be your cash receipts or collection. Then you might have a cash receipts from the sale of non-current asset. For example, again, if you are a company, the time when you will sell your asset, maybe inventory or non-current asset or plant and machinery, so that is also going to be your cash collection or cash receipts against the sales of non-current asset. Now here we have a cash or disbursement, like which items could be the part of cash disbursement. It is also called payments or outflows. So here we go, number one, interest payment on loan from others. Again, assume you have taken a loan. Let's assume you are a company. You have taken a loan from a bank. On that loan, you have to pay interest. So interest payments are going to be your outflows. Okay, then dividend payment to own shareholders, to our own shareholders. For example, as a company, you have issued the stock. Once you issued the stock, it was inflow. But the time when you will pay the dividend on those stock, it is going to be your outflow. So then you have a cash payment to supplier. Obviously, frequently we are buying the inventory from the supplier. Against that inventory, you have to make payments. So that is called your outflow or cash payment to supplier. Then maybe you also need to pay for certain business expenses, like maybe you have to pay rent expense, salaries expense, insurance expense. So all these are called your business expenses, and these are your outflow. But in your exam question, they may give you depreciation also, depreciation expense. Please note the depreciation is your non-cash based item. So there would be no inflow or inflow against this depreciation. Then we have here capital expenditure. What does mean by capital expenditure? It simply means acquisition of non-current asset. When you buy non-current asset, obviously it is not a free of cost. You have to pay something for that. So whatever the consideration or amount or the cash you will pay to acquire the non-current asset, that is also going to be your payment. Then you might have a drawings. Drawings means you can Just look this point in the context of small business. If you're running a small business, the time when you invest your cash into small business, that is called your capital. Okay, from business point of view, it is the inflow because business is receiving cash. So what is the drawings then? So when the owners withdraw the money from the business for its personal use, maybe I'm running a business, okay, so I'm going to withdraw some money from my business to pay my personal expenses. It could be maybe my house rent, my utilities for the house. Okay, maybe I'm paying for that. So that is going to be the outflow from business, because from business I am withdrawing, right? I'm going to withdraw this value. From business point of view, it is outflow because we are preparing cash budget for the business, not for individual. Then we have a purchase of stock or bonds of other companies. Obviously, the time when you invest in the stock or the bonds of other company, so it means you have to pay cash to buy the stock or bond. So it is your outflow. Then you have a repayments of loan, interest or principal. So obviously, the time when I took the loan from a bank, it was inflow for me. The time when I will return the money or I will pay the interest, this is going to be your outflow. Then you have a repurchase of your own stock. Sometime, let's assume if you are a company, at the time of issuance of stock, so it was inflow. But at the time of repurchase of stock, when I will buy back these stocks, when I will buy back, so this is going to be your outflow. So this is called repurchase of on stock. So these are not the full exhaustive list, but these are a few points which could be the part of your cash flow, okay, the cash flow budget. Understood? So this was overview. So now I'm going to talk about how the question could be tested in essay style question. So what kind of format you have to follow to prepare the cash budget. So here we go, guys. So guys, here we are going to talk about the format for essay style questions. Like if you are required to prepare any cash budget in essay style question, essay means in the long question. So then this format you can follow. Here what we are assuming, let's assume we are preparing this cash budget for the second quarter of the year. Second quarter means it includes the month of April, May, and June. So these 3 months, so we are going to prepare budget. Let's zoom and please remember in your essay style question, the examiner will give you data about the cash collection and about the cash disbursement and about the opening balance of the cash for specific month. So based on that, you have to prepare cash budget and you have to work with the, closing balance of the cash. So how it is going to work? So let's start. So I'm assuming here we are going to prepare the cash budget for the second quarter. So first, in the second quarter, we have a first month, which is April. Okay. So let's prepare first for the April. Then I'll tell you how you will move into the second month and then how you will move into the third month. So here we go. So let's assume we have here, first of all, for the month of April, we are going to work. Let's assume we have a beginning cash balance. At the start of April, we have a $50,000. By the way, from where you will get this value, it's a beginning balance of April. So it means it should be the closing balance of March. Understood? So let's assume it is given as a 50,000. So once beginning cash balance is written, so we will add here, cash collections, whatever inflows you have. So you may have inflow from the sale of non-current asset. So you may have an inflow as a collection from the customers, right? You may have an inflow as a dividend receipts on the investment. You may have an inflow, maybe you have received interest on your investment in the bonds. So whatever cash collections are there for the month of April, it will be listed down in the question, don't you worry. So you have to pick the data, you will write it here in this format. So I'm assuming, let's assume I have only one receipt. Okay, so let's assume it is 224,000. So once I'll take beginning balance, and if I will add cash collection, okay, whatever inflows are available for that particular month, if I will add it, so what it will give me, it you will get, so which is called cash available for disbursement, 274,000. So how you got cash available for disbursement? You took the beginning balance plus all the receipts of that specific month. Understood? So once I will add these two values, so I'm going to get cash available for disbursement. Then guys, you have to write it here, all cash disbursement which you are planning to do. So for example, I'm planning to buy some material A, like maybe raw material A, and I'll pay, for example, 51,754 in the month of April. Then I'm planning to pay some amount for the purchase of raw material B. Maybe I'm going to pay 20,000 for that, 20,864. Okay, so then maybe I'm going to pay some amount for the labor, 48,000. I'm going to pay some amount for variable overhead or fixed overhead, and I'm going to also pay for non-manufacturing cost like selling cost, administration cost. For example, maybe for the equipment purchase, I have nothing to do here. Maybe I'm not planning to buy any non-current asset, for example, in the month of April. So this value is 0. If you're buying any non-current asset, maybe you are paying 30, 40, 50,000, whatever amount it is. So you will write it in. So now this is all disbursements. So what I'm going to do, I'm going to make the total of all disbursements. So this is the total column, a total row. So here we got the total disbursement. Now what we do, what we will do, we will take this value, which is known as cash available for disbursement. From there, so we will deduct total disbursement. Okay, so what I will get, so this is known as surplus of cash. It could be deficit as well. Okay, because if cash available for disbursement is more than this value, so this is going to be surplus. For example, you can look at it. Cash available for disbursement is 274,000, and your total disbursement is 227,000 something. So if you will deduct, so this is going to be your surplus. Okay, it could be a deficit also. Deficit means when disbursements are more than cash available for disbursement. Okay, so let's say we have a surplus of how much? 46,344. So now guys, what we'll do here, so for example, in your exam, so he will tell you how much desired ending cash balance as a business you want to keep with you. This amount will be given. For example, I am planning to keep minimum $100,000 with me as a ending balance for this month. So I'll deduct from here. So this was the surplus of the month. For example, surplus was how much? 46,000 something. But I want to maintain ending cash balance 100,000. This will be given obviously. Okay, so I want to maintain 100,000, but surplus available is only 46,000. It means now, it means if you look, I want to maintain 100, but I have only 46,000. It means I have the final deficiency in this month. Understood? 53,000. So how I got this 53,000? The difference of these two values. Okay, the surplus of the cash available over disbursement and minus ending cash balance. So I got the deficiency because it is a negative value. Okay, so now what to do with this deficiency? Okay, so obviously guys, so next section you will prepare for financing section. If you will have a deficiency here, so here you will borrow. Then if you have a surplus here, then here you will make the repayments of the previous borrowing. So financing section mean to say how you're going to deal with deficit if you have, or how you're going to deal with surplus. So if you will have a deficit, you would borrow to cover that deficit from certain banks maybe. Okay, or if you have a surplus, you may return the previous borrowing, right? So that is why under financing section, so we will have a two categories, borrowing and repayments. In repayments, you have subcategories. Obviously, once you will repay, you have to repay the principal value also. you have to repay or you have to pay the interest on the previous borrowing. So here, so I have a deficit, and I'm assuming I do not have any previous borrowing. So I have a deficit of 53,656. So what I'm going to do to overcome this deficiency, I'm going to borrow same value. Okay, so let's assume I do not have any repayments of principal and interest in this month. If you would have, you would write it here. So now this is called what? Net financing. Net financing, how you got? You will take the total of financing section, this section. Okay, so you have only 53,656. Now, how you got the ending cash balance this much after net financing? So you will take, I'm going to tell you very shortcut way. Otherwise, there are long ways also to do it. I'll take this value plus minus this value. So what is this value? If you will look at it, this value is the surplus of cash available over disbursement. And what is this value? This value is the net financing. So I'll do the net of these two values. This is positive. This is also positive. So it would be equal to the ending cash balance. And if you remember, so our desired ending cash balance was 100,000. But do not worry, just take this value plus minus total of net financing section. So you're going to get ending cash balance. Okay, so then the ending cash balance of April is going to be the opening balance for May. Understood? Now, again, let's say we have a beginning balance here, that is ending balance of April. Then you will write it here, all cash collection, whatever you would have in your in the month of May. So I'll write it those. This is now if I will add these two values. So this is going to be cash available for disbursement. Again, from here, I will deduct cash disbursement. For example, I have these disbursements, payments, let's assume, in the month of May. So I'll make the total of disbursement, which is 253,353. So what we will do again, we will take this value, which is cash available over disbursement, minus disbursement. So this will give you surplus or deficit. So obviously we have here 438,000. Here we have a 253,000 something. So we have surplus of this month 184,647. Again, this information will be given in the question. What is the desired ending cash balance for the month of April? I'm assuming, let's assume again we have 100,000. We want to maintain minimum value. So now guys, so what I'll do, I'll take this surplus of cash available over disbursement minus ending balance. I get final surplus 84,000. Now guys, you have a final surplus. Okay, so what you are going to do with this final surplus of the cash? So now we will move to the financing section. So what we will do, because we have a surplus now, so if you have any previous borrowing, so we are going to repay those borrowing. By the way, you have to check your question in your exam when these borrowings are going to be repaid, then write in those months. So here I'm assuming the April borrowing I'm going to repay in the month of May. So that is why. So the first I'll take the principal value, which was the borrowing that I'm going to repay as a principal payments. Plus I will pay the interest on that. For example, let's assume these two values are available. So then what we will do, this is the total of financing section. How much? 53,880. The reason because we have repaid your principal value and interest value. So then guys, so what we will do, how you will get the ending cash balance for the month of May? Again, I'll pick these two values. Which value? I'll pick this value, which is called surplus of cash available over disbursement, and plus minus the total of net financing, okay, our financing section. So I'll plus minus, I'll get the final ending cash balance. Understood? So then final ending cash balance again will be the beginning for next month. Again, you will write, this is the beginning, then you will write cash collection for that month. So this is called now cash available for disbursements. For example, these are the disbursements. Total of disbursements are 325,000. I'll take this value, deduct this value. This is also called again surplus of cash available over disbursement. For example, again, I want to keep 100,000 as ending balance minimum with me. So I'll take the difference of these two. This is the final surplus. For example, I'll move to the financing section. So if I do not have any borrowing or principal repayments, I'll put 000. So then this is the total of financing section. Again, how you will get the ending balance, this ending balance, this ending balance. I'll pick this value. Which value? Let me highlight properly. This value plus minus the total of financing section. So this is going to be your ending cash balance. I hope it is clear, guys. So this is how you will work with the format for the SS style question. So is that clear, guys? Please confirm through the chat option. Now, guys, we are going to talk about adjustments, which could be tested in your essay questions also, or which could be tested in your MCQs as well. So here we go. First adjustment I'm going to explain that could be relevant to the gain or loss on disposal of non-current asset. So guys, we know it. So when you want to calculate gain or loss on disposal of non-current asset, what it means, like it is simply like when you sell your non-current asset, obviously at the time of sale, you could have gain or loss, right? So that is why this is what we are going to calculate. And gain or loss, how we calculate? We always take first sale price. Okay, so sale price. Sale price could be given with the name of cash proceed also. Actually, this is the value which we are going to get through the sale of asset, and it will be given. For example, this is the sale price 110. From there, you will deduct carrying value of asset. Carrying value of asset means to say the asset's book value. It's a book value of the asset which you are going to sell it. So carrying value is always equal to cost of the asset. For example, the cost of that asset which you have sold, it was $100, and you will deduct from the accumulated depreciation. It's a total depreciation of that asset. So with the let's assume it is $40. So 100 minus 40. So this is going to be your carrying value as a 60. So once you will take sale price minus carrying value, if your answer is positive, so this is going to be your gain. If your answer is negative, this is going to be your loss on disposal. Understood? So please remember why quickly I have explained to you the gain or loss. The reason for the cash budget, we always need sale price or the cash proceed as a inflow, So this is what we need actually. But in your exam question, he may not give you the sale price or the cash proceed directly. So what he will tell you, please just take a quick note. If your selling price is greater than carrying value, it is a gain. If selling price is less than carrying value, it is a loss. So, but for your cash budget, this is what we need. Selling price we need as a cash proceed, as an inflow. But in your exam question, maybe he will give you carrying value and gain, or he will give you carrying value or loss, but you have to get sale price. So how you will get? Simply, if you have a carrying value and if you have a gain, so you will add these two things. This will be equal to the cash proceed or cash inflow. If you have a loss, you will take carrying value minus loss. This is going to be your cash proceed or inflow. So this is what is written. Note, for a cash budget, we need a sale price, which might not be given straight away in the question. So what he will give you? He will give you carrying value or the gain or loss. Okay. Carrying value and the gain or loss. So you have to adjust then. You have to take carrying value plus gain is equal to sale price. This is your inflow. Carrying value minus loss. It is your selling price. It could be your inflow. Understood? So this is what is the first adjustment. So I'll apply this adjustment to the help of questions as well. So then we have here adjustment number 2, which might be given related to the working capital. So guys, there are 2 words. One is called working capital. Okay, actually it means investment in current assets. Understood? So then you have a fixed capital. It means like investment in non-current assets. But what is the net working capital? Net working capital is always equal to current assets minus current liabilities. So in simple words, the changes in current assets and changes in current liabilities might result in inflows or outflows, okay, of the cash. So here we go. So it means we have to study the rule for what is the rule for current assets and what is the rule for then current liability. And then what is the rule for net working capital? So three things we have to study. This is the same thing we have discussed already in the cash flow statement. Okay, so there's the same adjustment, just similar thing you will do it here. So please remember, whenever you are dealing with the current assets, for example, you have a receivables as your current assets. So this is your last year and this is your current year. In the last year, receivable were 100. In current year, receivables are 80. If you will look at here, so receivables are decreased by 20. Understood? So why it is decreased? Because we collected the cash. That is where receivable has decreased. Okay. You may assume maybe there it could be a bad debts also. So, but we assume it is a cash collection. Okay. Because we are taking net uh, receivable value. So guys, here will take increase whenever, even if it is inventory. Okay. So when the same rule you will follow, whenever there's an increase in current assets over 2 period, it could be inventory, receivable, whatever it is. But this is not a cash. Cash opening balance you will deal separately. So it's other current assets. So increase in current asset you will always treat as an outflow, and decrease in current asset you will always treat as an inflow. So you can look at here. So decrease in current asset was treated as inflow. Understood? Then same rule you will follow for the current liabilities. You may have a dividend payable, tax payable, maybe uh, as your current liability, maybe supplier payable. So these are your liabilities. So what is the rule for current liabilities? It is a little bit opposite. The same thing, similar thing we discussed in the statement of cash flows. So whenever there is an increase in current liabilities, so we always treat as an inflow. Whenever there is a decrease in current liabilities, we always treat as a outflow. For example, payables, payable value. So let's assume this is your last year, this is your current year. Last year payable was 200. This year payable is 80. It means payable is decreased by 120. Why decreased? Because you have paid. So that is why decrease in current liability is treated as outflow, and increase in current liability is treated as inflow. Okay, why? Because it's an inflow of the resources. That is why your current liability has increased. So then guys, in your exam, sometime you may have to apply this adjustment over the net working capital. Net working capital is what? For example, this is your last year. This is your current year. So last year current asset were 100. The current year's current assets are 120. Last year current liabilities were, for example, 80. This year current liability is also, let's assume 80. So what happened? So if you will take net working capital of the last year, which is current assets minus current liabilities, 100 minus 80, it is going to be 20. 120 minus 80 is going to be 80. So if you do not want to apply separately the current asset current liability rule, you can work with the net working capital also. But in net working capital, please remember, in the current asset, don't include cash and cash equivalent. Other than that, take it. Okay. So what we'll do, so we have a net working capital, for example, last year was 20. This year is the 40. So it has increased by 20. So on the net working capital, similar current asset rule you will apply. So whenever there is an increase in net working capital, look, it is a outflow. If there is a decrease in current asset, we said inflow. So same here, if there is a decrease in net working capital, it would be an inflow. Understood? So you may apply this also. So this adjustment will be given. I'll apply with the help of question. Just wait for 1-2 minutes. Then we have a third adjustment. This is actually not a accrued expenses. I would say it is a accrual basis expenses. Accrual basis, guys, your accounting, it is one of the accounting convention. Okay, and the concept of accrual says that income and expenses should be recorded in the period it is occurred or earned, regardless cash has been paid or has been received or not, right? So that is called accrual. So what is the point it here? So in your exam, I'm going to explain how adjustments would be given, because accounting followed accrual basis. For example, we are preparing cash budget for second quarter, and he told you accrual basis expenses. Accrual basis means it's accounting expenses, right? Because accounting is based on accrual. So accrual basis expenses is, for example, 1.2 million. Okay, so what we will assume, this is the accrual basis expenses for the second quarter. So we will assume these expenses have been paid in the same quarter, for your exam. Okay, so it means even it's written accrued or accrual basis expenses. So what we will do, we will assume as it has been paid in the same quarter. So this 1.2 million, so we will deduct as a cash payment in the quarter if you are preparing quarterly. Otherwise, you have to check monthly data, what it says. For example, sometimes he would say October salary is paid in the month of November. So then where you should write this outflow, obviously in the month of November. Then you have to follow actual point of payment. But if the question is silent, he told you accrual basis expenses for the quarter. So we will assume it is paid. Paid, just write as outflow. Okay, this is the assumption. Understood? Sometime, for example, I'm assuming accrual expenses, including depreciation is 100. So it means I can write as a outflow, but there is a problem with this depreciation because depreciation is your non-cash based expense. It should not be deducted as outflow. So for example, the amount of depreciation is $50. So total expense was 100, but this 100 includes 50 of depreciation. So what I'll do, I will take 100, which is accrual based expenses. I'll add back, or you can say simply accrual based expenses, deduct the depreciation because depreciation is your non-cash based item. So the remaining 50, I will deduct as a outflow because this is accrual basis, accounting basis expenses. Understood? So that I'll show you with the help of example. So here we go. Let's have a look with the help of question. Guys, I would suggest you please, can you read this question first? Now guys, let's assume, I'm assuming you have read the question. So here we go. For example, they are telling you a company is in the process of projecting its cash position at the end of the second quarter. Shown below is the pertinent information from the company's records. So we have a cash balance at the end of the first quarter. It means it's a beginning balance. So then we have a cash collection from customer for second quarter. We have accounts payable at the end of first quarter. We have accounts payable at the end of second quarter. We have all second quarter cost and expenses, accrual basis. It's accrual based accounting expenses. We have depreciation. We have purchase of equipment for cash. We have a gain on sale of assets. We have a net book value of assets sold. We got a repayment of notes payable. So then what is the question? From the data above, determine the company's projected cash balance at the end of second quarter. So you have to tell what is the cash balance. How would you work now? Simply you will work this way. So guys, so first of all, you will take, because ending balance you have to calculate, you'll start with the opening balance. Opening balance or the cash balance at the end of first quarter means it's a opening balance for the second quarter is 36,000. Then what you are going to do is, then you have to take a cash collection from the customer in the second quarter. This is cash receipts, 1.3 million. Then you have accounts payable at the end of first quarter. This is the opening payables. Then we have accounts payable at the end of second quarter. This is the closing payable. But payable has reduced by 25,000. I told you whenever payable, any liability is decreased, it is treated as outflow, so which is 25,000. It's a rule of working capital we are applying. Then all second quarter cost and expenses accrual basis, which is 1.2 million. So this we will deduct because accrual basis means we will assume it is paid in the same quarter. Then they're telling you depreciation expense, which is the part of accrued expenses included above. They're saying this depreciation is the part of this 1.2 million. So depreciation is non-cash based. So we can add back because we deducted 1.2 million full amount. So, but depreciation is non-cash based. So we can add it back. Or you can take 1.2 million minus 60,000. So remaining amount you can deduct. It's up to you. Then they're telling you purchase of equipment. So you bought it. It's an outflow. How much it is the outflow, guys? Outflow is 50,000. You will deduct it. Then net book value of assets sold. And you are given with a gain on assets sold. And you have a net book value. I told you if you have a gain and carrying value, so you will take carrying value plus gain is equal to selling price. And the selling price you will write as an inflow. So you will add these two values. 5 plus 35,000, it is 40,000. So you will add that. Understood? Then you have a repayments of the notes payable. What it is? Simply you have repaid the money. You have repaid the principal value. So it is your outflow, 66,000. So this is going to be a final cash balance at the end of the year. And answer is going to be 95,000. Okay. I hope so it is clear. Now, guys, we are going to talk about how to find a payment to supplier. Sometimes this is the question. Please remember, if you are calculating payment to the supplier, so here we go, just understand, try to understand. So we'll take the purchases. This is like treated as outflow. Obviously, when you buy the product, you have to pay the cash. So we will take cash purchases, the most appropriate word. So with the cash purchases, it's your outflow. Then you will take decrease. You will add decrease in payable, because payable, if payable is your liability. If it is decreased, it's treated as outflow. If it has increased, this is treated as inflow. You know, it's a rule of current liability. So that is why decrease in payable you will treat as outflow. So outflow and outflow will be added, obviously. But if you have increase in payable, then you will deduct that value. Okay. So this will give you net payment to the supplier. Please remember, in your exam question, you will have a one scenario. Either there will be a decrease in payable or there will be an increase in payable. Okay. At the same time, both things is not possible. Either it will increase or decrease or it will stay constant, right? Then this is how you will find the payment to supply. Sometime in your exam question, he may not give you cash purchases value. So then you will apply cost of goods sold formula to calculate cash purchases value. So what is the formula? You know how you calculate the cost of goods sold. This is how you are not a child anymore, obviously, guys, you know it. So cost of goods sold, shortcut formula is we take opening inventory plus purchases minus closing inventory is equal to cost of goods sold. Because I want to calculate this value, purchases. So I can reverse this equation. I can take cost of goods sold, this value first. And once I go reverse, so the minus thing will become plus. So it was less closing inventory. Now I will add closing inventory. It was plus value opening inventory. Now I will deduct opening inventory. So I will reach to the purchases value. Please also make sure. So sometime in your exam question, you will use this terminology, decrease in inventory levels, not inventory amount. Okay, decrease in inventory level. If he uses this word, so we'll treat as a opening inventory, and increase in inventory level if it is written, so we will treat as a closing inventory. Understood? So because why it is called decrease inventory level as opening and increase in inventory level as closing. So these concepts we will study under costing once we'll do the profit reconciliation, etc. Understood? But just remember here, this is the term which he can use. So decrease in inventory level is treated as opening inventory, and increase in inventory level is treated as a closing inventory. So here we go. Let me show you one question, how question would be tested. So can you read this question, please, guys, carefully? Yes, guys. So here we go. So I hope so you have read the question. So it says a master budget was prepared based on the following projection. We have here sales value, which is 2.4 million. We have a decrease in inventory level. I told you it is treated as an opening inventory. We have a decrease in accounts payable. So decrease in account payable is treated as outflow because we paid to the supplier. And then you have a gross margin. It is your profit percentage, 40%. So you have to calculate the estimated cash disbursement for inventories, or simply you have to calculate the payment to the supplier. I told you the format. What was the format? So first you need to get the value of purchases, cash purchases, which is going to be your outflow. Then you are provided with the decrease in accounts payable. Decrease in accounts payable is also you're treated as outflow. So both are outflow. So decrease in payable is given here 100,000. Okay. So but you have to calculate here now cash purchases value. This is what I'm going to work with. So how you can calculate the purchases value? So you can reverse the cost of goods sold formula. If you remember, I told you the formula. So first, just we are going to work with it. So normally what we do, we write it here. We write it here, opening stock, or if I will reverse the direct formula, we need cost of goods sold plus closing stock and minus what? Opening stock. This will give you the value of purchases. Okay, as I told you in adjustment, how to reverse the cost of goods sold formula. So cost of goods sold, how you will find it? So he told you gross margin or gross profit is the 40%. Okay, 40% of sale value. So sale value is also given. So what we will do, sales less cost of goods sold is equal to gross profit. So sale we will always assume 100%. Gross profit is given as a 40%. It means cost of goods sold is the 60% of sale. So what I'll do, I'll take 60% of sale. Sale is how much? 2.4 million. So this will give you one value. So if you can work, please can you tell me, guys? It is, guys, going to be, if you will solve it, it is going to be 1.44 million. Okay, so this is your cost of goods sold. Now closing stock is given, uh, because this we have already done. Decrease in accounts payable, increase in inventory, decrease in inventory is given. Decrease in inventory means a opening stock. So that is how much is 60,000 we will deduct. So we do not have any information about closing stock, so we'll put it 0. So what we will do here, so 440 minus 60, it is going to give you 1.38 million. Okay, so this value is called your purchases value. So this value you will write it here, 1.38 million plus 100,000. So this is going to be your payment to supplier. So payment to supplier is going to be how much? It is going to be 1,480,000. Understood? So this was a requirement. So it means what is the correct option? Correct option is D. Okay, I hope so it is clear. Then guys, there is another way to solve questions relevant to the cash budget. So for example, sometime here I'm going to tell you now how to reach cash balance by using income statement approach or income statement data. It's also called indirect method. So guys, in your exam question, so he may give you net income. Like here you are going to convert profit after tax, which is also called net income. This is always on accrual basis. So from this value, you are going to move to the cash basis. And for that, you are going to do some adjustments. Okay, so this is called how to reach cash balance by using income statement data. So what we will do, we will always start with the net income value, because this I want to convert to the cash basis. It is always on accrual basis. So we will add here non-cash expenses like depreciation, because depreciation you have deducted in the income statement. So now you will add it back because it is a non-cash based item. Then you will deduct your capital expenditure. It is the expenditure for acquisition of non-current asset. It is nowhere written in the income statement, but it has cash outflow. So you will deduct it. Then you have a decrease in working capital is always treated as an inflow. And then you will deduct increase in working capital, you will deduct, because these two adjustments are also not written in the income statement. Because if let's say if you make payment to the supplier, so debit supplier, credit cash, it's no way, it's not written anywhere in the income statement. So working capital adjustment you will do. Then for example, you will add your opening balance of the cash. So this is going to give you closing cash balance. This is called indirect method. How question would be tested. So here we go. For example, a company has just completed its prospective financial statements for the coming year. Relevant information is summarized below. So we have your projected net income on accrual basis. We have anticipated capital expenditure. This value we will deduct. We'll take net income, which is $100,000. We will deduct here capital expenditure, which is also called capex, 50,000. So then you have here increase in working capital. So increase in working capital means net working capital. So increase in working capital is treated as outflow. Okay, so that is 25,000. So then you have a depreciation expense. It's a non-cash based. You will add it back 15,000 if you will solve it. So you are going to get how much value? Do you have any opening balance? Do you have any opening balance here? It's given. So opening balance is not given. So opening balance is 0. So you are going to get it here. Cash balance of 40,000. So this is going to be your cash balance of 40,000 is going to be your answer, which is going to be B. Then guys, there is another kind of question which could be tested. So he may give you the data and we are going to learn now how to drive cash collection based on sales forecast. Okay, so then I'll reverse. So we can calculate cash payments based on purchases forecast. So here we go. This is another type of question. And this is the most common way of testing in your exam. So how it is going to work, let's do directly with the help of question. So guys, for example, we have a data here. A company has developed the following sales projection for the calendar year. So this is the sales projection. Whenever sales projections are given, it means you have to calculate inflows or collection. If purchase projections are given, then you will calculate outflow or payments. Okay, so here we have a sales projection. So here we go. So we have a month of May, June, July, August, September, and October. These are the sales projection for those months. So then they told you normal cash collection. Experience has been that 50% of sales are collected during the month of sale. For example, if you made any sale in the month of January, 50% you will collect in the month of January itself, and 45% in the month following the sale. Like 40%, 45% you will collect in the next month. Like January sales, and you will take times 45%, it will be collected in the month of February. Then remaining 5% is never collected. So we have nothing to do with this 5% because it is no more your cash collection. Then company's budgeted cash collection for the third calendar quarter are. So what is the question? Try to understand, please. Third calendar quarter. So we have your question. So what is the collection for third quarter? So third quarter means you have to find the collection which will fall in the month of July, August, and September. So this is the third quarter, right? Any payments or any collection which will fall in this month. So we will write it here. So here we go. Please, July, August, and September data we have to pick. So here we go. We have to apply this collection experience on each month sale. So what I'm going to do it here. So this is how you can solve it quickly. He told you 50% you are saving in the same month, 45% you are saving in the next month, and 5% is never collected. So May sale you will take, 50% will be received in May, and 45% will be received in June. It means nothing is falling in July, August, and September, so ignore this. Then you will pick June sale. And what is the experience of collection? That is 50% you will receive in June. Yes, we do not need because we need for July. And then 45% you will collect in July because June sales times 45% will be collected in July. So this is what we need. So if you will solve it, you can take 120,000, which is June sale, into 45%. So this collection will fall in the month of July. This is the June sale times 45%. So this will fall under the month of July. And this is going to be, if you will take 120 times 45%, it is going to be 54,000. So this is one collection which falls under third calendar quarter. Then you will take July sale. This 50% will be received in July, we need. And 45% will be received in August, we also need. Because July, August, and September we need. It means we are going to see 50 plus 45, 95% of this sale. So what we'll do, we'll take July sale, and which is 140 times 95%, because 50% will be received in July, 45% will be received in August. The total is 95. So this is going to fall in this third calendar quarter. The amount is going to be 133,000. Because I'm not using the calculator, that's why I'm looking at the answer. Then you will take August sale. Yes, from August sale, 50% will be collected in the same month, I mean say in August, and 45% will be received in September. Yes, both we need. August and September we need. It means we need 95% of this value. So we'll pick August sale value, which is 160,000. times 95%. So this value is going to be how much? It's going to be 152,000. 52,000. Then we will pick August, sorry, September say. September 50% will receive in September. We need 45% will receive in October. We do not need because we need July, August, and September. So we'll take a 50% of 150,000. So we'll pick September value, which is 150,000. And we'll take 50% of that, which is going to be 75,000. Okay. Then October sale, it is already beyond the September because we need for third calendar quarter, August, September, July, August, and September. So October, you do not need to consider. Now you will add all these collections and it is going to be total 414,000. These are going to be the collection for the fourth calendar quarter. So guys, I'm going to a question on your screen now. So this question you will try by yourself. It's similar kind of question. I hope so it is clear, guys. If you have any question, you may ask me, please.